Hi, welcome to this podcast where I'm going to be looking at limited companies and just the latest of the final accounts. This one is not long. Should be able to get it done in about 6 or 7 minutes maximum. A little bit of additional theory we need to know about limited companies. Big advantage of becoming a limited company. Obviously, we discussed it in the last podcast. Limited liability is a big advantage for the actual owners. They haven't got to stand all the costs. And therefore, the business and the owner are actually legally separate. So in theory, as an owner, you're not going to go to prison for something that the company has actually done. What most companies, though, do have are regulations governing the directors. And if directors sanction things to happen in a business that do then cause to injury of, for example, a member of the general public, then the legal action will actually happen against the directors of the company. You can sell shares to raise finance. It's obviously an advantage. Continuity, unlike a sole trader and a partnership without a partnership agreement, a limited company continues to exist after the death of an owner. And here's one I don't really like. It may be easy to raise loans or sell debentures. Certainly sell debentures is important. We'll talk about debentures in a minute. You can't really do that as a sole trader. Raising loans... A small, very small limited company will not find it particularly easy to raise any loans when it's first started, because the banks know that they've got limited liability and therefore are less likely to pay the loan back than a sole trader who owns a house. But to a degree, limited companies generally will find it slightly easier to raise a normal loan as well. Big disadvantage in most countries, certainly in the UK, anybody can see the accounts of a limited company. There's a place in a town called, or a city called Cardiff, which is in Wales, where you can contact them and they will send you the accounts out. There's loss of control because once you start selling shares in your business, all the shareholders get to vote on certain important things in the business, and obviously profits are shared between all the shareholders. Two last bits of important theory. Debentures, what are they? Well, they're really a type of loan, but it's a type of loan where each year you only pay the interest on the loan. So you're not repaying the amount of money borrowed like you do on an ordinary loan every month or every 6 months. That repayment occurs on the last day of the loan. So in the short term, that's good for the business. They don't need to find a lot of money early on to start repaying the loan. Obviously, it's a bad thing at the end of the loan, because at the end of the loan, they need to repay the total amount. So with an ordinary loan where the interest and the amount owed is being repaid on a monthly or 6 monthly or yearly basis, there are larger payments initially because you are repaying part of what's been borrowed. Right, this bit's going to be really simple, which is why it's only part of our homework. Layout of an income statement for a limited company is very similar to what you've seen before. So inventory plus purchases, that's the closing inventory, gives you your gross profit. No different to what we've seen before. One thing that's a little bit different, although there's been a little bit of a change on this, it will affect some of my students, but not all of you. We then calculate the profit from operations, so the profit before the interest is being charged. Okay, and we do that because of the return on capital employed. And then we take off the interest, and then we find out the total profit for the year. Okay, so for this business, profit for the year is 50,000. It's important we do that for a limited company, because when we calculate the return on capital employed, it's the choice of the business to have loans, and therefore the interest or the finance costs aren't considered to be part of the profit for comparing the return on capital employed. It's a 60,000 that we'd use, not the 50,000 profit. Statement change of equity, we've already done that. As you can see down here, I've put the profit going in and the retained earnings. We know how to do that. And here there's been a dividend paid. Be careful, make sure you only consider the dividends paid. Occasionally you get a trick question in an exam where they talk about the dividends that are proposed at the end of the year. They haven't been changed, they don't affect the statement of change of equity. Okay, and then statement of financial position. Just be a little bit careful with your non-current assets. Okay, if you're given the trial balance amounts, don't forget to add on any interest charges for the year. Here I've just put the figures straight in. You've got an inventory of 20,000, we've got the current assets, add them together to get your total assets on a particular date. So nothing different there to what we've done before. These two sections down at the bottom, your current liabilities, non-current liabilities, are no different to what you've done before. So we would add together, for example, our debentures and bank loan to give us our total non-current liabilities. If we got more current liabilities, we'd add them in. This bit is a bit different. All we do in the capital section, we look at the information that would come from our statement of change in equity, and we put the year-end totals for each of our reserves in. So in this case, we've got 2 reserves, put the totals in, I add them all together, and then I add all my liabilities and capital up to get the total figure. Okay, so the reason why it's really quite a simple thing to do, and the reason why if you just get asked to do one of these questions, it will effectively be a sole trader question, but in there you will probably have to calculate the depreciation for the year. You may have to do calculations with accruals and prepayments. So the key difference is, first of all, make sure that any interest charges are shown separately. So we've got a profit from operations before interest for use in our return on capital employed calculations, and we've got a final profit for the year. You will need to do a statement change of equity because we need to know our totals for our capital, and the information then for the totals at the year end of the capital go into the equity section. Student example for you guys to do. It's pretty straightforward. I don't think you'll have any problems with it. You'll have to fill in the statement of change of equity. It's got a dividend paid and dividend proposed. Remember what I've said. Good luck with that. Look forward to seeing your answers, and I'll speak to you soon. Bye bye.